Right now, it's sitting at the highest level in about 6 months, and quite frankly, just a whisper away from the recent highs that it had, I think, back in 2020. Our next guest actually sees gold as an attractive opportunity for investors. Michael Cuggino joining us right now, president and portfolio manager over at Permanent Portfolio Family of Funds. Mike, great to have you here on the program. Give us a sense. I mean, what actually is the thesis behind it? Is it that the Fed's out of the way and now gold can kind of do its thing that most investors expect it to do?
Hey, good afternoon, Romaine. Thanks for having me. That's one of several factors, I think, and I'll try to list them or some of them. First off, I think the dollar is going to continue to come off the highs it experienced in the last couple of years, and actually more broadly from the last decade or so. It reminds me a lot of the 1990s when you had a strong dollar and gold languished, only to catch up in the ensuing decade and a half after that. The dollar we expect to revert to the mean, and I think that would be one factor. It's been unusually high vis-a-vis other currencies. The second would be the Fed, like you said, close to being done, if not done already, and possibly cutting, if you believe some of the news today. That means that real rates of return could be lower or smaller or even negative, depending on how rates go. That's generally bullish for gold. Central bank buying around the world remains strong, especially among some of the countries that are looking to, if not displace the dollar, then at least create an alternative payment scheme around the world using, gold as a backing for some sort of transfers of payments for trade and other things. We've seen it with the Ukraine-Russian thing, and the oil that's trading, the Russian oil trading around the world. Geopolitical risk is still out there, and that's a factor as a threat to the financial system. And then lastly, the fact that gold has held up incredibly well despite volatile rising rates the last year and a half. You would have expected to see something like a complete fallout in the price, usually. And I would go back to 2013 and the taper tantrum and all that to look at how far gold fell during that rate increase. And gold held its own very well over the last couple of years. So we wouldn't advocate overweighting it, but we think that most portfolios could use some of it like we do as an anchor in a broader diversified strategy.
And I'm sure you know that over the last few years, a lot of people sort of strayed away from gold, at least as a physical hedge that it would traditionally play in the portfolios. Maybe that's because, A, they either didn't feel they needed to hedge or they were able to find other sort of non-physical assets to hedge against. Do you worry at all that some of those trends that had led us to where we are today, meaning non-physical assets, whether they're talking about crypto or some other things, might actually be competing for gold's attention?
Well, gold doesn't pay interest or dividends. It's capital appreciation. It's a hedge against inflation and declining unit value of currency. So that is an issue, especially when you can get higher yields in other places or just plain growth. You're right that people didn't feel like they needed a hedge over the last 10 to 15 years. Equities were going strong. The dollar was strong. Interest rates were low. Geopolitically, it was kind of a calm period. So who needs to hedge with gold, right? But this is a very different world and a very different set of circumstances, and investors need to keep that in mind. So that would be part of the thesis as well in terms of, where we are right now. Those factors are always at play. And so that's why you want to use it as part of portfolio planning. But, unless you're a real true speculator or trader, you're probably not going to trade in and out of it based on short-term factors. We would basically say with gold, you figure out how much you need to be properly diversified in your eyes. You wait for periods where it's reasonably priced. And over the next 3, 5, 10 years or so, you would expect it to be higher.
So a place for gold in the portfolio. Let's talk about the rest of the portfolio. You mentioned, of course, if the Fed cuts rates, then the real return on bonds will be lower. But how are you thinking about fixed income at this juncture?
We think there's still a lot of uncertainty. Clearly, rates have come down quite a bit lately. And I think everybody's trying to step over each other, figuring out when to lengthen duration. A lot of firms have already done it. Some are considering it. And then at how long do you go, right? We've taken the opposite stance, I think, from that conventional wisdom at the moment. We're relatively short, 3 years in. We're taking advantage of the real high rates, mainly because we see more volatility that maybe hasn't been fully reflected, either in economic activity or just interest rate volatility, supply, demand, the size of the U.S. debt, global considerations, et cetera. So, like everybody else that manages bonds, we're sensitive to lengthening duration, and we'll do so gradually or opportunistically, but we're also looking to take advantage of shorter term rates right now, which are still relatively high.